Hello everyone, my name is Harish Raju and this presentation is of an equity research report. RealNetworks is the company I'm going to talk about. The ticker symbol for RealNetworks is RNWK. The price per share on October 29th of 2013 was $8.37. The target forecasted price end of 2014 would be $5.93. And our recommendation would be to sell the stocks. Coming to the highlights, RNWK spends large amount of its capital buying new equipment or investing in a new facilities. It can be noted that 80% of its profits are being spent on capital expenditures like property, plant and equipments, which are required for the business. RNWK has more cash than its total liabilities. This actually can help RNWK sustain itself in the face of any economic turmoil and makes a stock buyback more of a possibility. RNWK has signed an agreement to sell a significant number of its patents and its next generation video codec software to Intel for a purchase price of $120 million. RNWK has recently shown an inability to deliver results for shareholders. This could be due to a poor management and it recently has a highly erratic net profit margins, which are a great cause of concern. This company in future may operate in a highly volatile industry due to competition from its competitors. So let's look at the financial summary of RNWK. And all these numbers are coming from year-ending statement on 31st of December 2013. As you can see, the market capitalization was 274 million, the cash was 226 million, the revenue 206 million, the operating cash flow was a negative 49 million, which means more cash is flowing out of the firm than it is coming. Stock price thus will drop in future. Dividends, RNWK does not pay any dividends. So this is my summary of analysis. RNWK's inability to produce positive free cash flow for the majority of the past 10 years is the main concern for me. It should be a red flag since this company does not have a track record of delivering results for shareholders. This should be due to poor management, as I already stated, or the nature of its business. And my recommendation at this time is to sell the stocks. So let's look at brief history of RNWK as a company. RealNetworks was founded in 1994 and is headquartered in Seattle, Washington. RealNetworks, then known as a Progressive Networks, was founded by an ex-Microsoft executive, Rob Glazer. RealNetworks provides network-delivered digital media applications and services to manage, play, and share digital media. The company operates through three segments: Real Player Group, Mobile Entertainment, and Games. The company is the creator of Real Audio, a compressed audio format, a Real Video, which is a compressed video format, a Real Player, a media player, and a Real Downloader, which is a download manager. Companies in this industry design, develop, publish, and support software for multimedia production, editing and distribution, graphics and web design, and desktop and online publishing. RNWK has so many competitors, as you can see in the diagram, and I particularly observed that this industry is highly volatile. RNWK is ranked way below at number 64 in this list. So let's look at the SWOT analysis of real networks. Coming to the strengths, a large amount of capital on hand gives flexibility to create new content. It can acquire third-party content, invest in businesses, acquire businesses, and can also repurchase shares as well as pay interest and taxes due to a large amount of capital. Multi-year affiliation deals create reasonably stable source of affiliate fee revenue, and investment grade credit rating provides adequate access to capital markets given cash needs. So this would be the strength of the real networks. Uh, the weakness, it must respond to rapid changes in consumer preferences and behavior, which would be resulting in vast change in technology and distribution platforms. Revenues, expenses, and operating results vary based on the timing, mix, and number of the availability of the programming and motion pictures. And loss of affiliation agreements with the content distributors could also cause revenues to decline in any given period or in a specific market. So the market is highly volatile. The changes in the US or a foreign communication laws or other regulations could adversely affect businesses. Let's see what opportunities real networks have. Partnership with Microsoft to distribute content online, new entry into interactive media, expanding presence internationally to focus on regions and demographics that offer the greatest growth opportunities for real networks, and alternatives for pricing, structure, and volume of advertising and commercial segments to reflect its new rating methodology could be some of the opportunities that Real Networks has it in hand. Threats, the major threats for this company would be piracy. Piracy of brands, motion pictures, television programs, and DVDs, and increased cost of programming. And failure or destruction of satellites could negatively affect ability to distribute the content. And in 2013, the company acquired Slingo Inc. and Musical Limited as well. And coming to the Porter's five competitive forces, uh, let me explain each of it briefly. Barriers to entry. I gave it a very low because, as evident by the huge number of players in the EDP services market, barriers to entry are very low. Costs of developing a product are relatively low, and a few thousands of dollars are all that may be needed to create a product and step into the market. Threat of substitutes. The boundaries of the market are very vague. So, under this banner, just about anything under can be passed off as an online collaboration solution. Email, social networking sites, activity streams, project management solutions, mind mapping solutions, web conferencing solutions, intrant tools, real timing, co-authoring, many more. So threat of substitutes are very high. And coming to the bargaining power of the customers, this would be depending on the particular segment we are talking about. So, since many of the players in this segment are mega corporations, the bargaining power of the customer is extremely low in certain cases for the small business segment. But in the enterprise segment, the customers themselves are the mega global corporates. So, the bargaining power is a lot more. Therefore, it's hard to make a sweeping statement for this entire industry. The bargaining power of suppliers. There are no suppliers to speak of in this industry since all that is needed is an idea and some coders to get it up and running. The competitive rivalry. The above forces have come together to ensure that the market is intensely competitive. But given the huge size of the market, which is still relatively nascent, and the prospects of its growth, the market still offers room for a profitability. So let's look at the key executives of this company. The key executives, Mr. Robert Glazer, since founding RealNetworks in 1994, Mr. Glazer has played an integral role in the transformation of the internet into the next great mass medium. Mr. Tim M. Van is the Chief Financial Officer and Treasurer. Tim Van is the senior executive responsible for global finance operations at RealNetworks. Mr. Scott G. Umonto is a senior vice president of the Real Player Group for RealNetworks, drawing upon 22 years of industry experience. And Michael Farham has served as a RealNetworks senior vice president, general counsel, and a corporate secretary since August 2012, and previously has served as an associate general counsel in IBM. This table enlists the major mutual funds holder and the top institutional holders. The tables are self-explanatory. This is the statistical data that I got from the Yahoo Finance. And coming to the technical analysis of real networks that I found, the chart above shows the price and the volume for Real Networks Inc. from May 2013 to present. The volume has been fairly steady over the past year with a few temporary spikes, as you can see. In addition, the prices has continued on an upward trend since September 2013, when it was reported that the figures should begin to stabilize in the company. Next, we start looking at the financial analysis and what it means to the real networks. I'm going to start with the short term, and again, every one of these is coming up but from the information that I got from the year ending data of the balance sheet 2013. So what does it mean? Since earnings per share are negative, they fail to add value to shareholders' wealth, and the prospects of this improving are quite low. Therefore, we advise stock be sold. The current ratio measures whether or not a company has enough cash or liquid assets to pay its current liabilities over the next fiscal year. The ratio is regarded as a test of liquidity for a company. So short-term traders will prefer a high current ratio because it reduces their overall risk. So that's good part. However, investors may prefer a lower current ratio since they are more concerned about the growing the business using the assets of real networks. This means its total assets would pay off its liabilities 3.7 times. So that's about the current ratio. Coming to the quick ratio, it's higher. We can interpret that company keeps too much cash on hand or has a problem collecting its accounts receivable. So RNWK can meet its current financial obligations with the available quick funds on hands. The cash ratio, we can interpret that RNWK ratios is not allocating enough resources to grow its business. And coming to the next slide, we see that the profit margin, the negative profit margin, we see that there's a negative profit margin. So any decrease in revenue will result in a decrease in profits. So once a company's sales decreases below the total amount spent for expenses and costs of the goods sold in a given period, a net loss will occur. That's what it's happening. Poor pricing strategies may be one of the reasons. Ineffective marketing programs, competition, inability to keep up with the market changes, and inefficient marketing personnels are common causes of the decreasing revenues of RNWK. Negative return on assets. This occurs when a company or a business has a financial loss or a lackluster return on an investment during a specific period of time. RNWK thus as a ROE of negative. It means its shareholders are losing rather than gaining value. This is usually a very bad sign for the investors and managers, and they would be trying to avoid a negative as aggressively as possible. And we see that the receivables turnover that we collect is 8.27, which means that we collect money 8 times in a year from a credit, and it takes 36 days or approximately like 44 days uh, to get it done. And the total asset turnover says that for every dollar an asset we have, the sales of is 60 cents. And as I said, the ROE, the negative ROE, the company has a negative ROE which is of an minus 18.7%, and the price per earning ratio is calculated to be 5.04, and the market to book ratio is to be calculated as 1.11. Coming to the cross-sectional analysis of RNWK, the below table compares its competitors. The ROE of RNWK is being compared with the major competitors. We can see that Axion Corporation, Advent Software, and Alscripts Healthcare Solutions are the major competitors for RNWK. These are also ranked above the 60 mark, which we saw on the previous slides. The figures show that the RMWK is struggling with a low EBIT margin of only 0.26%. And coming to the financial analysis and the forecasting, this is the last slide of this. Uh, this is the EPS, which is in negative in the 2013 physical quarter. 2012 physical quarter was good for RNWK with EPS of 1.28, and 2011 was negative as well. And as it's a negative, EPS is in negative, so earnings per share are negative, so they fail to add value to shareholders' wealth, and the prospects of this improving are quite low as per me. Therefore, we advise the stock to be sold. The above calculation here, 19.10%, indicates that in order for this to be a good win investment, it must generate a return of at least 19.10%. The needed return will not be earned during the next year, and in fact, it is quite likely that the money will be lost if the stock is purchased at the current price and held for the next year. So, my recommendation would be to sell. And thank you very much.